Recently, personal finance guru Susie Orman appeared on a podcast where she was asked how much money was needed for a secure retirement. This was her conclusion. You might need 10 million, just so if you're making 5% on that money after tax, you'll be fine without touching your principal. Ouch. Late bloomers, do you have your $10 million? Will you have your $10 million? Have you even considered that you might need $10 million?
$10 million. Bank of my choosing. Offshore immediately.
Okay, let's bring the blood pressure down. That's a lofty goal. You may even be laughing at it. Susie's take may be controversial, but she may not be as crazy as you're thinking. When you consider factors like where you live, your lifestyle, and unexpected things like long-term care, health crises, and inflation, it might be fairly conservative. One thing's for sure, $1 million ain't what it used to be. So, how do you get to whatever your goal is? A big part of it should be investing in companies you already know, love, and buy from. I have a free tool that I'll share with you to help you build your watch list.
Mike's free stuff. Get a ton of value. Pay diddly squat.
It's never too late. It's a couple of years ago, and my wife and I are sitting in a swanky office with a financial advisor. This guy had treated us to a free steak dinner seminar at a local restaurant and offered to analyze our retirement readiness. We still felt pretty far away from this, but okay. So questions were asked, numbers were crunched, bottled waters were drunk, and a busy spreadsheet is protected on the screen in front of us. With a big smile on his face, the advisor points to the bottom line and says, "So you see, Mike, you're in good shape. Just keep saving. Keep investing with us. We'll be safe. We'll be conservative. All you need to do is just keep working at your job until you're 70 years old, and you'll be a millionaire." Now, I don't know if he expected us to jump up out of our chairs and do a tango around the conference room, or to at least be pleasantly surprised. And I'm sure we said polite things and smiled. But as time passed after that experience, I grew increasingly disturbed. First of all, the age 70 thing. Can I visualize myself working at my corporate job, taking the fixed biweekly paychecks, hoping and praying for a bonus every year, saving up the hours for brief vacations for the rest of my 50s and through the entirety of my 60s? I mean, I don't even know if my company, let alone my job, will exist in the year 2036. If I end up on the cutting room floor in my 60s, how do you think that job hunt will go? And what will $1 million be worth in 2036? Remember when Millionaire was impressive? Anyone remember this guy? Gilligan's Island was a very popular show in the year I was born, 1966. Thurston Howell III. Being a millionaire back then was considered wretched excess. By contrast, if you won $1 million in the lottery today, it would probably be taxed around 35%, leaving you with $650,000. Invest this at a conservative 5% interest rate and spend just $80,000 a year, and this fortune will be completely gone in 10 years. Much, much sooner if you buy a supercar or a new house. You and I can't afford to settle for just enough to survive. We don't need to be prepared for what life costs. We need to be prepared for what life will cost and what it could cost if things go haywire. Haven't we been around long enough to know things go haywire? Meanwhile, I see real fortunes being made all around me by people younger than me. Maybe some of them are smarter than me, but I'm sure some of them are not. They've simply made better financial choices, chosen more modern paths that are coherent with the 21st century. Many of the younger generation, millennials and Gen Z, have already rejected the traditional path of college and a job, and some of them are making out like bandits in the digital economy. That's okay. FOMO serves no real purpose except motivation and inspiration. I'm blooming late. You can too. One of the first steps is to start following publicly traded companies you know and love. Why do you follow certain people on social media? Because they're interesting. You trust that they're going to continue to produce good content that you want to read and watch. Just do the same thing with your favorite companies. Stalk them. Let's take Google as an example. We all have a love-hate relationship with these guys, sometimes more hate than love. Yes, it's a monopolistic digital empire driven by the greed of advertising and profits. But it's hard to say we're not fans when they're such a big part of our everyday lives. You're watching YouTube right now, for crying out loud, and you got here from Google algorithms that pegged you as a potential late bloomer. They impressed this video in your feed. This video was edited and uploaded from a Chromebook powered by Google at no cost to me when with no downloaded software required. We use Google Search and Gemini AI on a daily basis for information and instructions. The very words drive, photos, docs, sheets, and slides, what do they have in common? Well, they all meant something different 20 years ago because Google and because of these iconic icons. They also own Nest and Fitbit, by the way.
They're everywhere.
But did you know that the legal name of Google's parent company is Alphabet Inc., and that a share is currently worth about $170? Or that the company is worth over $2 trillion when you take the number of shares in circulation times the price? Did you know that when Google reported earnings per share on October 29th, they reported a positive surprise of almost 15% more than what was forecasted? I only know this because I just looked it up on this Google Finance page, where it is readily available and costs nothing. Because Google is a publicly traded company, their books are open, and there are few secrets about their financial performance. Would you consider investing in Google, knowing that shares purchased in 2015 are worth more than 6 times as much today? Did you know that if your IRA or 401k is invested in an S&P 500 or NASDAQ-based fund, that you're already invested in Google, to some extent, whether you knew it or not? Now, maybe you've learned something here, maybe you haven't, but that's my point. You don't need to go to school to learn this stuff. It's all out there, and there's no paywall. I'm going to throw out a scary word. At least it's intimidated me in the past. Analysis. To me, analysis means to apply the power of my brain to something to make sense of it. When I'm analyzing something, I'm looking at it from multiple angles to determine how my observations can benefit me. We're all analysts of many things in our lives. If we're going to succeed in investing, we need to become analysts of these companies. There are 2 major types of analysis. Fundamental. This is analysis not of the stock price itself, but the company and everything behind the price. Who's the boss? What is the history of quarterly and annual revenues and profits, earnings per share, debt ratios, sector and industry comparisons? Does the company have products that will continue to be in demand? What are the best sources for fundamental analysis? Google Finance has a page with the basic fundamentals of every company. You may think of Yahoo as a post-90s has-been search engine, but I'm telling you, Yahoo Finance takes it up a level on their fundamentals pages, and you may consider making them your go-to. technical analysis. This is analysis of the price action itself, observation of buying and selling, the patterns of historical trends on multiple time frames, volatility, volume of shares traded, trends, strengths, weaknesses, awareness of market participation and drivers. Fundamental events like earnings reports and macroeconomic news will, of course, impact technical price movements. This is the study of data points. Google hasn't bothered to move very far into this arena, but Yahoo, they have by far the best technical charts you can find outside of an investment platform for free on the web. This is an incredibly robust free resource. There are dozens of intelligent indicators based on price and volume. You'll need to invest time in learning what the indicators indicate and how they can help you make trading choices. Investopedia.com is, well, it's exactly what the contraction implies. An investment encyclopedia you can use as a learning base for all things fundamental and technical. This can be overwhelming. We'll cover a lot of it in future videos. For now, I'd like to provide you with a free technical analysis resource you can add to your Google Drive to start building your own watch list of companies you care about, companies that could make you rich. You'll find the link to this free resource in the description below the video, but here's a preview. It's a simple yet elegant Google Sheet with our sweet late bloomers branding here up top. Over here to the left, you can build your watch list of up to 20 companies you're interested in keeping an eye on. Let's just come up with 5 companies you might buy from regularly. Of course, there's Amazon, with their truck rolling up to your front door more often than the milkman did back in the day. Netflix is fun, as long as you can control your binging impulses. If you've ever booked a vacation with Airbnb, or even rented your own property with them, they could be on your list. Let's say you like to shop for leggings and party-colored briefs at Lululemon. And of course, Costco. If you're in Costco country, you probably can't live without those huge bales of toilet paper and those juicy rotisserie chickens. You can grab this handy drop-down handle here to change it to whichever of your watch list stocks you want to check up on. Let's look at Amazon first. We see the current share price here, and to the right we have some numbers that can really help you to get to know the character of our stocks over the past year. These formulas will pull in the closing price for every trading day over the past year. The average daily change in price for Amazon is only 0.13%, indicating general stability. The standard deviation on a daily basis shows how much it changes from a running average throughout the year. Again, this is a relatively stable number. Over a year, the stock's volatility averages just 27%. This is a number that really only makes sense when being compared to other stocks. The biggest single-day increase this past year was just under 8%, and the largest down day was just under a 9% drop. On those same days, the price went up $12.53, and on the biggest down day, $16.17, respectively. To put this in perspective, if you'd owned 100 shares of Amazon on the largest up day, you would have gained $1,253 on that day. And on the worst day, your investment would have lost $1,617 in value. This chart below shows the distribution of daily changes. You can see that nearly all the changes are grouped around the plus or minus 2% range, with just a handful of outliers. On most days, not much happens at all with Amazon stock price. These charts show the price history over the past year, 2 weeks, and 3 months, allowing you to visualize the short and long-term trends. The 1-year daily change trend shows you the ups and downs referred to in the section up here. You can see where that worst day was here on August 2nd, it looks like. What the heck happened on August 2nd? Well, that's why we're here, to educate ourselves and get to know this stock. So we'll Google, why in the heck did Amazon stock drop 9% in August 2nd? And see what comes up. Haha, second quarter earnings, missed expectations. Tale as old as time. Look at this projection of 148.5 billion in revenue, but analysts had forecasted up to 158 billion, so there were some high expectations that they didn't meet for that quarter. That was enough for nervous sellers to come in and drop the price 9% that day, and it would be more than a month before it got back to where it was before that day. Now, it only takes half a second to choose another of our watch lists, say Lululemon, to review the same things. Clearly, Lulu makes great underwear, but man, they've had a rough year in 2024. Looks like the stock price started above $500 in January, but by August it had tanked to less than half that. It's now fought back up above $300, but again, what happened? Look at this worst day. Almost a 16% drop in one day. If you'd have owned 100 shares, you'd have said adios to over $7,500 in paper losses on that day. March 21st. What in the world? Here we have a Yahoo Finance article detailing those fourth quarter earnings that resulted in the tank. We won't get into the details because that's your job. I'm just teaching you how to fish. Anywho, that's what I've got for you today. I definitely want you to have this, and it'll cost you zilch. Two things. Please subscribe to this channel. It's the only way to avoid missing a new release video. Then hit the description below to get this sheet copied to your Google Drive. You can thank me later. You will need to have a Google account to do this. These sheets will not function in Microsoft Excel because of the embedded Google Finance formulas.
#sorry not sorry.
Now, if you copy the analyzer, you will receive an email asking you to confirm your subscription. This is referring to the free Late Bloomers newsletter. I want to make one thing very clear. I do not offer free stuff just to get your email address and then try to sell you stuff. If all you want is just this one freebie and you do not want to be part of the Late Bloomers community and receive more in the future, please unsubscribe immediately. I don't want unmotivated subscribers, and I will spam no one. We're building something organic and real here. Get in on the ground floor or get out. The Late Bloomers journey of mindset, money, and legacy is just getting started. Please hang with me to continue this journey to lasting prosperity. My name is Mike, and I'll be back next week with more. And if I'm not, it means I'm dead.